Hey. So I'm gonna try something different. I'm between two plants again, so maybe I should discuss a finance topic. Which starts at 3 minutes and 30 seconds, discussing the whole FIRE movement and risk tolerance, and at 6 minutes and 15 seconds for kind of a more succinct 3 rules. I initially wanted to go over 3 rules for trading and investing psychology, but really this became broader than that and is just 3 principles that are good to be mindful of for investing, with specific examples in trading as well as more general ideas. But I'm gonna replant my croton. These come in a variety of different species or just like different types, and there's like this type that's orangish and has like a flame ribbon shape, or one that almost looked like a bunch of maple leaves, but this one really, I was almost gonna get like all of them just because I'm going down the rabbit hole of like plant aficionado way too fast, which I think happens. I think this like plant collecting hobby snowballs after you're at like plant number 15 and you're just like, you know what? I should just get everything. But this one, when I pick things, I'm like, oh, this one really gives me joy for some reason. Like these pink feathers on the outside and over here, just really pretty. I like it a lot, and so I just decided on this one, and I have one that was like a good value plant, so I have that downstairs. I'm gonna repot that too. But yeah, so let me just do that. I'm gonna put this in like this hobby room with a bunch of stuff, and I pre-filled it with some dirt and such because I realized I don't want to get like this tub too messy. But yeah, I'm just gonna take this out gently. All of $4 or $5, and maybe I'll put on my other glove. But yeah, so multitasking even more. Let's see if I can stay up for the challenge. I have another golden euonymus, which is usually a outside shrub plant. But I think it's really pretty, and especially the ones that have both yellow and green leaves. And so I'm just putting it in like the study room. But yeah, just loosening up some soil. This is hard a little bit, but it's okay. I wanted today to talk about the psychology of trading and investing. And I mean, I feel like this is a different meaning sometimes for various generations. Obviously, your time frame to retirement and whatnot is different, and that obviously affects your risk profile. Like the older you are, probably the lower the risk you want with everything. But it's also interesting with the younger peeps. So here you can see all the roots. Ooh. Wow, they look nice and healthy. Like this, I don't know if I can like zoom in on the various roots there. But yeah, nice and healthy. So I'm glad I got this joy-inducing plant. There was this whole FIRE movement, and apparently there's also like a coast fire, like coasting to retirement with the FIRE movement and whatnot. And my opinion with that, I mean, it plays into psychology too. I mean, how is that going to affect your risk tolerance now? I suppose you have to be really aggressive earlier or more aggressive, and then slowly kind of put things out to savings because you need to use it. But my opinion is, how about you just try to make as much as possible and save as much as possible? I already pre-filled it with soil. That could be a good way. But yeah, so there's my potted croton. It's great that people are getting educated about it, and it's good to aim for that. Hopefully whatever you build, it's like passive. I mean, a lot of creative endeavors like making a course or a plethora of other things involves passive income, royalties for creative things, book royalties, music royalties, or just art that you can sell prints for, whatever it is you really love. Even YouTube, like that's in a sense a royalty, because every time someone clicks on an ad, that's a little bit of moolah streaming to you. So it's great in a sense, but I just think like calculating to the $1,000 your fire income is kind of moot, because you never know what's going to happen. And so it's good to aim for it ASAP, but I wouldn't quit and then start spending it, because I just don't think that's prudent. And a lot of other things that are more passive, like real estate, that being a nice landlord and finding good tenants is like, you know, a low-key way to making a good imprint on society in a way, because there's plenty of like huge corporations that are really just more in it for profit than a tenant's well-being. So I mean, there's a lot of different ways you can go about it, but I wouldn't necessarily just fire. Anyways, so the psychology of trading, I think, and investing. First of all, one, you should define your risk tolerance. Age has to do with it. Just your general attitudes, such as if you're just really entrepreneurial and you don't mind betting biggish, but this is the most important thing ever. Risk management, mitigating your risk. It's more important than finding something you can make a lot at than actually making gains, in my opinion, because, and in a lot of highly respected people's opinions, I think, is because if you're over leveraging, it's just irresponsible, you know? You're using someone else's money, putting it to malinformed decisions, and then basically bankrupting them like a bank or whoever else. And okay, if you have the charisma and talent and connections to go ahead and make that investment, okay. And you're providing jobs, which is nice, but honestly, I think that's one thing that in the States is more, it's caused amazing success in a lot of tech companies, for example, though that's a little different because that's like venture capitalism and not like banks necessarily lending in like real estate projects for Trump. And I don't claim to know the internals, I just know it's, you know, a whole different industry with different standards and different underwriting criteria. But I just think that's irresponsible for society. So, and okay, you want the glory and the guts, it's irresponsible for yourself. You want to lose money? Okay. And have that like record for you. So first is risk management, risk tolerance. Make sure it aligns. Even if you're like a daredevil when it comes to it, just still take daredevil steps, if that makes sense. If you just take daredevil dives and plunges, I think that's a recipe for disaster. Not only for yourself, but for people you employ, for whoever's giving you that money and whatnot. And to be super conservative is good in a sense, but it's also like buying a bond. Like, what's the point? Like putting your money in a 0.01% interest savings account. It's a little bit too much in the conservative side and whatnot. So that's number one, is risk management / tolerance. Number two is know what you're involved in. Really study it to a certain extent. You don't have to know every nook and cranny of things, and sometimes that can cause analysis paralysis, but have enough information that you can make an informed decision about. If I don't know anything about real estate syndication, okay, you can just blindly go for it. That's probably a safe-ish thing, but I'm not comfortable doing that, you know? Like, if I don't know, but you know, someday I'd like to be more informed about it. I just haven't built a critical mass of knowledge where I'm ready to do so and I'm comfortable doing so, and I can be adequately informed for that. So that's number two, is knowing what you're getting into. Same thing with penny stocks. Don't just randomly buy one. I mean, you could, but what's a great tip, for example, for stock trading is only to do one thing. Only to trade a couple of things, watch how they move for months, and then get in and out, because you're more familiar with those few stocks, say 3, because not all of them will have moves every day. So if you actually wanted to be like a consistent trader, you can just follow 3 or so stocks. Maybe just one could be perfectly fine too. But if you, it depends how much time you wanted to dedicate it to it, and if you just want to make some little side income, or if you wanted to be able to make more from it and from your starting capital, because if you start with a small loan of $10 million, you could just not really do anything and just be fine. And yeah, unfortunately, or fortunately, for the sense of like having to hustle, that's not most of us or me. So that's number 2 is really know what you're getting into, to a certain point, to make informed decisions, informed, educated, titrated decisions. And never, like, don't go all in necessarily, just know the titration of that, in a sense. And the third tip for psychology I have is just to have more than one thing going on, in a sense. Because if you just watch the markets like all 9 to 5, for example, for futures, you could just decide the ES, NQ, or gold or something. If you splay yourself over like 20 different things, unless you're doing it long term and you're like, they're like someone who just wants to accumulate different stocks, and maybe, if you accumulate 100 one's really going to go to the moon, then that's cool. And actually there was one person who was like a janitor or whatnot for his entire life, and then just like ended up with 8 figures or something, or at least $8 million, and donated it to a library at the end. And he lived completely frugally and whatnot, and no one had any idea he had that much. So unless you want to like kind of take that approach and really just long term it, and you don't mind some things melting down and other things doing really well, then that could be cool, just to buy as many things as you favor, in a sense. But on the short term, I would say in the short term, it's okay too. You see a technical pattern on a chart and you just want to get in and out fairly quickly. So it depends, but in most cases, for most people who I think are doing like mid to long term, whether you're firing or you're like close to retirement, I think it's prudent to obviously just kind of know what you're getting yourself into, the asset classes, the specifics of how that particular ticker symbol or whatnot moves. And the third thing would be to have almost diversified interests, because if you're watching every tick on the markets pass by, you're just probably going to be upset at some point, because you're going to be like, oh no, why I just bought it and it went down so much. Or like, you're just going to be a plethora of emotions. Sometimes it's great, but oftentimes it's also not, and you have to get out fast. It's a training thing. It's like driving, in a sense. You need to know, if you're really doing it more frequently, when to get out quickly and when to hold through a small rough patch or whatnot, and only to risk what you can afford to lose, in a sense. But I wouldn't say it's gambling, especially if you take a midterm approach and you don't mind holding. The last thing is just to take your mind off things. Like, it's really scary sometimes in the beginning, because you're just not used to any of that. As in any endeavor in the beginning, there's a lot more work and anxiety and stress and whatnot. But it's well worth it, I believe. And just being informed about something that's really important and having a go at it. So to develop that kind of psychological threshold training to be able to be calm and emotionally even. You can do paper trading at least to kind of develop the skill of the technical like ins and outs of how to do things. But when you do have real money on the line, obviously it's a bit different emotionally. So it just all depends. So those are my 3 tips for the psychology of trading. I'll see you guys next time.